All right, well, the weakening consumer is weighing on retailers. Lowe's seeing a 4% decline in comp sales in its latest quarter as do-it-yourself shoppers continue to pull back their spending. You're looking at losses of just about 2.6% here in the name. But despite that, it did come in better than expected, slightly better than expected. So let's talk about what exactly is going on. What is ahead here for Lowe's? For that, we want to bring in Michael Baker. He's D.A. Davidson Managing Director and Senior Research Analyst. It's great to see you. So when you take a look at the reaction that we're seeing to Lowe's print here this morning, comp sales did beat. Is Lowe's making inroads? And do you think this decline that we are seeing is justified here this morning?
Well, so you're right. The comps did come in a little bit better than expected, down, but down less than we thought. And they narrowed the gap versus Home Depot, which is really important. So that's the positives. The negatives were that the gross margins were lower than expected, and the margin gap between Home Depot is actually widening. And we think what really may have hurt the stock is during the call, the company talked about the second quarter margins being impacted a little bit more than what is in consensus estimates. So the consensus second quarter EPS estimates are likely to go down, and we think that took some of the wind out of the early morning sale on the better than expected comp.
Well, I'm curious about the situation with Lowe's when it comes to home prices. From Torsten Slok this morning showing that home prices are up 7.3% in the past 12 months, Michael. Should higher prices, which could indicate some more demand, be a bullish signal for Lowe's or not necessarily?
Well, no, absolutely. One of the more important drivers of demand is home price appreciation, and Torsten's right. We have seen that improve, I think now on a year-over-year basis, 8 months in a row. So that is a positive for sure, but there are also negatives. Turnover is way down. There are other pressures that the consumer is facing. So we have some positives, we have some negatives. It all mixes out into, again, continued negative comps, but less negative than the last 2 quarters, less negative than expectations. And at least their guidance suggests that we should get better in the back half of the year. So countervailing winds, home price appreciation, definitely on the positive side, but again, there are offsets.
If we do see rates stay high for longer, what exactly then does that mean for Lowe's, just in terms of some of that pressure that we could continue to see on their business?
Yeah, that's a negative for sure. Higher rates, less home activity, that home price appreciation that we're seeing get better. Maybe that turns back for the worse if turnover slows because of rates. So the stocks and the businesses are definitely driven by rates. Higher for longer is not a good scenario for these guys. So they will react positively, again, both the sales and the stock, if and when rates start to come down. That's frankly what bulls are waiting for. That's been delayed, and that's probably why Lowe's stock has underperformed year to date, at least relative to the market.
I'd love to take a step back and look at the overall sector here, Michael. We know that retail stocks have seen short interest climbing over the past couple of weeks, and there's a lot of pessimism overall on the consumer discretionary sector. If we're meant to be greedy when other people are fearful, is that a buying opportunity for the sector, or should investors be looking for individual names for opportunities for growth?
Yeah, I mean, I think it is a stock picker's market in general. You do want to pick your spots, but we are generally positive on retail, just on the idea that we do think we are closer to the end of the rate cycle than the beginning. Retail stocks do perform well when rates fall. That's been pushed out a little bit. So retail has underperformed a little bit year to date, but eventually we do think rates are going to come down, more likely down than up from here. And we do think that'll be a positive for retail stocks. So we do see it as an opportunity to buy names. Lowe's is not one of the ones we're recommending. There are other names that we are recommending, but we do see opportunities out there. One of our preferred picks, for instance, is Walmart. We just elevated Walmart to what we call our best of breed bison product, which really highlights long-term winners at good valuations. We see that as a name continuing to take market share in this environment, and we think that stock works, for instance.
Michael, you also cover Target. That's going to be the next major retailer to report results this week. It certainly has been a bit of a mixed picture so far. What are you anticipating that we will be hearing from Target?
Yeah, the benefit for Target right now, I suppose, is that expectations are very low. We're looking for same-store sales to be down 4%, so not a very high bar. The key, though, is that they need to reiterate their guidance that comps should turn positive as early as the second quarter, the quarter that we're in now, and then be about flat for the year. So that'll be the key. We think first quarter will be down. They start to cycle some issues that they had last year, and so we need to see an improvement in the second quarter. Also a name we're recommending for different reasons than Walmart as an example. Target we see as a turnaround story. Again, likely the fourth quarter in a row of negative comps for the first quarter, but we think that turns back to positive. Margins should then benefit. We think get back to closer to historical trends, which are about 6%. Prior to the pandemic, the margins were about 6%. They went way up during the pandemic. They plummeted in 2022 when they had the inventory problem. They're now low fives. We think eventually their margins get back to 6%, and that'll be the catalyst for the shares.
Is Target's reduction of prices for 5,000 items bullish or bearish for the stock?
We think it's a positive. I think the key right now is for them to get customers in the door and win back some traffic and win back some market share. So we think it's the right thing to do and should pay off, with positive comps later in the year.
All right. Well, I'm sure Jay Powell would love to hear you say that, Michael. Thank you so much for joining us. We appreciate it. That was Michael Baker, DA Davidson Managing Director and Senior Research Analyst.